All right. What's up, guys? I hope you're doing well. James here from jamesdforesight.com. And I wanted to go over a recent speech given by the new Vice Chair of Supervision, Michal Barr. This was given at the Brookings Institution in D.C. And he started, I think he was sworn in on July 19th or so. But anyways, his basically his whole it seems like the whole premise of his job is to make the financial system safer and fairer, which is probably why he named the speech as such, right? So with that being said, we'll just head straight over to it and get right to his seven different, I call them categories because that's kind of what it seemed like. It wasn't like these are seven ways I'm going to do this. It's kind of just him breaking up his kind of, I guess we'll say, job requirements into seven different categories on like which he wants to like improve or do whatever for the financial system, right? So I just call them categories. Okay, so success in financial regulation and supervision does not mean standing still because finance does not stand still. The regulatory and supervisory framework adopted after the crisis recognizes that innovation and change are constant in finance, that our understanding of existing and emerging risks can and should deepen over time, and that regulation and supervision must evolve to be effective, right? So basically, and this is something he kind of repeats in different wording throughout the entire speech, is that basically it's constant improvement in a way. And I realize saying improvement in this context is rather subjective. So there's that. But basically, it's a continuous process of more regulation, or I guess more accurately, adaptive regulation, as a kind of you would expect from a complex system. At least that's what comes to mind. So, and by the crisis, he's talking about the GFC, right? We're not talking about the pandemic explicitly in this part of the speech, right? So, still on the GFC, a significant cause was excessive risk taking by banks and inadequate regulation and supervision by the Fed and other bank regulators. A hard won lesson from the crisis is that the savings of every retiree, the job of every worker, the payroll of every business, and the well being of every individual depend on a safe and stable financial system, right? And so I guess what I think that this kind of last little part of this paragraph kind of highlights, per se, is kind of how politicized this is in a way, because it kind of runs contrary, or at least it seems to me to run contrary to what they're pretty much explicitly doing right now with raising interest rates and tightening monetary policy, right? And I put that in quotes for a reason. Um, and where I'm going with this is it basically, and I believe it's been explicitly stated by Jay Powell, but I may be wrong about that, to where basically inflation is the number one vice at the moment, right? And basically the whole point is they have to bring it down to their 2% expected target, regardless of the casualties, right? Whatever collateral damage is necessary, it seems like they're willing to take. And this has been stated quite a few different ways from different Fed governors throughout the past couple months, maybe even few months. Um, so it's kind of like is it really the savings of every retiree? So like maybe I guess you could lump their 401ks in there, but when you're explicitly trying to take down asset prices, in this case like the stock market, I'll say like paper market, because I guess you could lump bonds in there as well. But when you're explicitly trying to do that, can you really say that's the whole point? I guess I'm trying to say. It's just that, but it's also keeping it in context, 'cause, like, he's new to his position, and it's also like a very politicized role in a way. It's kind of hard to argue that there isn't some degree of politics within the Fed, right? It's one of those, some argue that it's not supposed to be, but also with an application, it's kind of like, how is that actually applied? And that's more of an open ended question than a statement. So fairness is fundamental to financial oversight, and I being Michal Barr, um, am committed to using the tools of regulation, supervision, and enforcement so that businesses and households have access to the services they need, the information necessary to make their financial decisions, and protection from unfair treatment. Financial instability unfairly harms those who are economically vulnerable. So, making the financial system safer is making it fairer. Okay. And it's one of those things, too. I'm of the mind that it's pretty much always up to the application of such regulations and things like that, where it's because things like this can become so political so easy, it's hard to remain objective about how the actual, like, we'll say, effects of, say, a new regulation or even the current system we have or whatever, right? And so putting an emphasis on the safety of the financial system, it's also like worth mentioning, like, how are you defining safe? um is it basically ultimate control by the Fed? Is it, what is it, right? um Keeping that in mind. And also with kind of the whole making it fair, it's like, how are we defining fair? And it's not, and this is more to bring up questions, and kind of open discussion and kind of a longer term, I guess, series of videos, or just kind of a general idea in general, because it's all, also you have to keep in mind context. I mean, this is just a speech. You're not going to get into this much of an in-depth argument to really delve into the nuances of these types of questions. How are we defining fair in a financial system context, that sort of thing. It's very difficult to get a very nuanced answer in a short form format, relatively, for a speech, unless you want to sit there for literally hours, um, to get it done. That's something you have to keep in mind, is always keeping things in context. And I always thought that was funny with people, with especially with social media, is because they get so heated about something that's stated in, say, a 30-second reel or whatever. It's like, you got 30 seconds. It's like people don't pay that much attention. So you have to kind of view marketing for marketing and go from there. But that's neither here nor there. Don't want to get too far, excuse me, off. But anyway, the first category he gives is capital, right? So basically saying that's kind of the most fundamental part of the financial system, and kind of this in terms of stability and safety and that sort of thing. And so basically, to continue to perform these functions being the regular functions of a bank, like lending, that sort of thing, banks must have a significant level of capital to ensure that they can absorb losses and continue operations during times of stress in the financial system when losses may be significant. So, an important principle of the capital framework is that it must evolve through a continuous process of incorporating new risks that may emerge, right? Again, must be able to adapt to new environments, as you would expect from such a complex system, or what should be a complex system in a way. And so he kind of gives, it seems, three total principles in this regard, that being the first one. The second one being that this capital framework should be risk focused, right? So it depends on the type of risks. So different activities pose different potential for losses, and the capital regime should calibrate requirements to account for the risks of specific activities. And you see this with, say, the leverage ratios, like the SLR and that sort of thing, to where different, we'll say, investments or assets that a bank may purchase are weighted differently with respect to risk. And you kind of have to keep that in mind with investing too. I think people get too caught up in, like, overall return and not so much on a risk adjusted basis, which is really what I think you should be focusing on, depending on where you want your emphasis to be. Is it return of capital or return on capital, right? It's kind of still different concepts. So the last principle, is that requirements should be tiered. And so you're basically talking about GSIBs, so like globally, systematically important banks, right? And so basically, is like the more important the bank, the more interconnected it is with the financial system in general, the more important it is for kind of the global monetary system, the more regulations and the harsher the regulation should be, right? And that's also with respect to what they can handle. So if you have, say, a Bank of America or a JP Morgan, they can handle and afford to deal with much more and much harsher regulations than, say, your local community bank. If you start asking the same, asking this, if you start requiring the same actions or, I guess, publishing requirements. For some reason, the word's escaping me right now. Basically, where they have to report the same reporting requirements um, of a community bank that you expect of, say, a JP Morgan. The community bank's basically just going to be underwater the whole time because they just can't afford to have that degree of reporting and basically just adhering to regulations, because you have to hire people, you have to basically have on-site, I guess, auditors in a way to basically keep everything maintained. It's not a small order to fulfill, so you need that kind of size in general. So when calibrating requirements, we will work to minimize unintended consequences, limit opportunities for gaming, and avoid excess compliance costs that do not result in risk reduction. And the compliance costs are basically what I was just talking about. So taking a holistic view will help us consider adjustments, if any, to the supplementary leverage ratio, the SLR, counter-cyclical capital buffer, and stress testing, right? And especially stress testing, I have a few videos on, basically the like results and such from a lot of I think the recent one. But anyways, the second category being resolution. So basically, a sufficient amount of capital is really there to support the resiliency of an individual bank. Um, but however, if they still go under, it's one of those things. Resolution is kind of how he's defining. Is like, how do you basically resolve this bank without a costly bailout that is paid by the taxpayer, right? And so how do you make sure that it's those financial institutions that pay and not the government, right? And so basically, the Dodd-Frank Act established the framework necessary to end bank bailouts. It provides the FDIC with the authority to resolve any firm whose failure would pose substantial risks to our financial system in a way that will protect the economy while ensuring that large financial firms, not the taxpayers, bear any costs. In addition, the Fed and FDIC require large banks to develop living wills to demonstrate that they can be resolved in an orderly way, right? And I didn't know this about the living wills, so I have to look more into it and kind of see exactly how exactly that's being applied, because I wasn't expecting that when I read it, or at least I didn't know about it, I'll say. The next category is kind of bank mergers, and so you'll see this a lot if you look at like the regular the Federal Reserve website. They do a lot of press releases when there's a major merger or things like that. So mergers are a feature of a vibrant industry. The advantages that firms seek to gain through mergers must be weighed against the risks that mergers can pose to competition, consumers, and financial stability. And that's another priority of his, is basically to evaluate or their approach to reviewing such acquisitions, right? And so basically what this chalks up to is preventing monopolies of banks. I guess it's arguable to say that that's probably, I could see an argument to where that would be seen as a complete failure, but also kind of a counter one. It's one thing I've noticed when studying the banking system and the monetary system in general is it's very, very nuanced, and there's a lot of different ways to look at these types of things. So, and the reason I say monopolies is basically this next, what I highlighted in green. So, a merged institution may be able to provide more competitive products and services, but it could also have a potential to reduce competition and access to financial services in a geographic area by raising prices, narrowing the range of services offered, and reducing the supply of small businesses or community development loans that rely on the local knowledge, right? So, basically, having a kind of holistic view bank that looks at an entire region and not on a local level, to where you don't really have that small business or community development to go along with pretty much the exact words that he's using, right? And so, really kind of getting too big to pay attention to the smaller players is a worry of too much kind of merging, I guess you could say. Now, the next category is stablecoins as private money. Basically, they're coming after them. It's something I've done a few videos about. Of they're really starting to talk a lot more about regulating crypto, and he says the phrase explicitly later on. It's like the same. See if I can remember it off the top of my head. Same risk, same regulation, same reward, or something along those lines. A bunch of sames. Basically, regardless of the technology, um, such a, we'll say, object like a stable coin or whatever other type of, say, regular financial product, I guess product's a better word, um, is going to be regulated the same. So, like if you have a stable coin that has the same risks as, say, a stock, terrible analogy, I know, but just giving an example. Basically, since they have the same risks, they should be regulated in the same way, is the argument for that, right? So they also have the next one is financial risks from climate change. Basically, they're trying to see how climate change is affecting banks' balance sheets and how that could pose risks to the financial stability. Um, Obviously, not so much a direct effect, it'll be an indirect effect of how that could affect how climate change could affect the assets on such bank balance sheets, right? It seems to be the argument as I jump all over the place. So, in addition, we are considering how to develop and implement climate risk scenario analyses. In that regard, next year, we plan to launch a pilot microprudential scenario analysis exercise to better assess the long term climate related financial risks facing the largest institutions. So basically, it seems like maybe this will be something that's added to like the SLR, kind of like on a risk adjusted basis or some equivalent, or at least related to, I guess similar to. Um, Basically, banks aren't allowed to invest in oil and gas, or maybe like pipeline companies, or whatever. I don't know, some company that specializes in mining equipment, things like that. I don't know. Basically, to exacerbate the underinvestment in those industries already, right? And so just not going down that whole rabbit hole per se, just kind of bringing it up to where that seems to be kind of where they're going with this part. Um, at least that's what comes to mind when I read it. So maybe you have a different opinion. If so, put it in the comments, whatever. That's kind of the whole point of the videos, to be honest, is to kind of like provoke discussion and really try to. This is basically me researching and kind of going through what I've been researching and kind of talking about it. One, to help my understanding, trying to articulate it better, but also putting it out there so maybe other people can find things that they may or may not have found anyway, or along those lines, right? So I believe this is the second to last category. So innovation, access, and consumer protection. So everything before this, the other five categories have been with respect to kind of the safety of the financial system. As so now we're getting into more like the fairness. So in the past, he's described the three essential elements of fairness in the financial system as the three-legged stool, because all three are necessary for any aspect of fairness to work. And so basically, these three categories are essential elements are financial capability, financial access, and consumer protection, right? So, in terms of financial capability, an important component is transparency and the cost of services, which means making sure consumers have the information they need to make good decisions. And that's one thing that, and coming down here to talking about innovative financial products, and you can see cryptos in here again. Like at one point, and this is something that I've been kind of thinking about in my quote unquote free time. It's like, especially with related to crypto, and I've brought this up in a few of the videos about it. It's one of those things like, how much do they have to hold your hand? Um, and how, like, I understand making, I understand the regulations to like for the companies themselves to obviously not hide anything. So, like, the reporting requirements and stuff. But it's also like, if you make that more public knowledge and it's a lot easier to get, or people are more aware of it, then it won't be such a problem, I think. And it's one of those things, if people are just kind of throwing their money into things they don't understand and they get bit, it's kind of like, how do you teach a kid not to touch a stove? Like, that's kind of my thinking in that regard too. Yes, you don't want people to like lose their entire life savings and stuff, but it's one of those things, if they're just haphazardly doing that or throwing their money into things and not thinking about it, not actually trying to understand or get that kind of um, investor's mindset of like perpetual learning and study, then they're playing with fire. And so, like, if you get burned, it's kind of like, don't play with fire. It seems like at some point it's like those people you see at like I don't know what they're called, but the Hawaiian sort of islander thing where they have the poles and they have the ends are on fire and they're twirling them and stuff like that. It's like, at what point do you become the kid playing with a stick gets burned on the campfire to become that Hawaiian dancer, whatever, playing with fire to that degree? And it's kind of like, that's how you have the, I guess we'll say, immature investors in a way, and then to the actual like professional ones who they don't have to worry about anything. Or, well, I don't want to say worry about anything, but even they know how to hedge risks and that sort of thing and to basically protect themselves, right? And at what point do you just have to like let people get burned? But whatever. Oh, and here's that saying earlier: same risk, same activity, same regulation, regardless of the technology used for the activity, right? So the last final category is community reinvestment. I've noticed they've started bringing this up much more. I think mostly because they've been changing the bill or kind of refining things with it. So the Community Reinvestment Act, it was first passed in 1977, so quite some time ago. Well, I don't know, quite some time, relatively about 50 years ago. I guess 45. But anyways, basically earlier this year, the OCC, the Fed, and the FDIC jointly invited comment on a proposal designed to strengthen and modernize CRA, Community Reinvestment Act regulations to achieve the objectives of the law. Basically, the whole um, fairness thing for banks. Like, I think one of the parts of it was banks had to have at least one branch in what did they say, underdeveloped like financial areas. So, like, I think I explicitly remember, I think it was a blog post on the New York Fed's website, Liberty Street Economics. To basically, they were talking about um, is with respect to Native Americans and like how the proportion of banks relative to Native American populations was like something stupid, like less than 10%, or like 10 times less than the proportion with respect to like other demographics or in other areas. And it was like supposed to be like severe, like rural areas in specific parts of the country. And so that was kind of the whole like, banks were required to have at least one branch in these kind of areas and something along those lines, right? I obviously don't remember the exact part of the act, but that was kind of the general gist. So with that being said, we'll stop the screen share, hop back over here. So that one went a little longer than usual. So either way, I'll put the link to the speech um, in the description so you can read it yourself. There's always also it's a speech, so there's a little tab where you can click watch live and you can actually watch the speech if that's your preference. I just prefer to read them instead of hearing people talk about them. I just retain it better. But anyways, with that being said, I'll leave this one here. So I hope you guys have a good night, and I will see you on the next one.